Hi, folks. This is Sean Hyman, and I wanted to talk about the dollar and the overall outlook for the dollar because traditionally you'll hear the textbook type of story that professors will teach in universities and things of that sort is that when interest rates are raised, it's good for a currency, and when interest rates are lowered, it's bad for a currency. And in isolation, that is true. But the problem is nothing works in isolation in reality. So there's other slices to the pie that affect things like the currency, like the dollar. Um, for instance, money flows from foreign countries to the U.S. and outflows from the U.S. to other foreign countries affects that as well. Um, how how well the economy is doing overall can affect that as well. Things of that sort. So there are all kinds of things that don't make the textbook situation that the professors teach in colleges and universities just quite accurate and quite true when it comes to real life trading and investing. And so the dollar had actually gone up during an interest rate reducing phase. So that contradicts what is taught by textbook. And then over the last so many months, the Fed has been slowly raising interest rates, and you would think, by textbook, that that would cause the dollar to be more bullish and go up. Yet it's actually gone down over the last several months, and and the technicals don't look any more promising for the dollar. It doesn't now, could it, bounce back up and everything? Of course it could, but it's not likely to, and here's why. Downtrends, as they go down, they tend to have, and I'm not drawing a line on what's actually on here, I'm just giving a visual. When downtrends go down, the bear market bounces tend to have these three waves up, so an A, B, C up. And so, if so, here would be your A, your B, and your C right here, which is the bounce back up within an overall larger downtrend in the dollar. Um, and because this is a 10-year chart, but if you look at over 20, 30 years, there's a long-term downtrend and a bounce up within the overall downtrend. And the C wave of that tends to have five waves up, which is 1, 2, 3, 4, and then 5. So when you look at that, and then when you draw a trend line on wave 5 here, and it's broken right around where this 50-week moving average is, so it's broken below the moving average and it's broken below the trend line. There's a huge chance it comes down and retests this 91-ish area. And if it breaks below the 91, 93 area on the US dollar index, which you can go to stockcharts.com, put it in $USD, and the free charts only go back a few years or so, but you'll still be able to see what I'm talking about. And you won't be able to go back 10 years on the free charts. You have to subscribe to go back further in time, like 10 years or something like that. But you can see a few years just on the free charts. And so anyway, the dollar's been heading lower recently when the Fed's been hiking rates. The RSI has been dropping, so it's divergent. In other words, as this was hitting higher highs, this was hitting lower highs. So that shows a slowing down of upward momentum and a weakening in the dollar. Same thing, the divergence that was happening with the price heading up, putting into higher highs here and lower highs on the MACD, again another sign of weakness, and the MACD dropping below the zero line is another sign of weakness once again. Coupled that with we're already 5 waves up and what's likely a wave C, we could see a massive ABC or 5 waves down unfold. Either way, there would be quite a bit of downside. Then when you go to the daily charts, that was a weekly chart, weekly 10-year. When you go to the daily chart on $USD, which is the the dollar index, the dollar gets a basket of a handful of currencies. I think it's like 6 major currencies, which really have them 5 or more major than some of the others. I think one of them is like the Swedish krona or something like that. So, and the bulk of the weighting is against the euro itself, so it's not an equal weighting as well. So, but it just goes to show you broadly how the dollar is doing against a number of currencies. So when you look at the USD on US dollar on daily chart, it's going back 2 years. You can draw a trend line here, and the dollar broke that trend line in April, and it retested the downside of that trend line in May, and then continued to drop, and it formed one of these bearish crosses, what some call a death cross, and that's a bearish sign. Now, sometimes they can go and flip back up, but remember, when you're already at the end of a wave 5, that's when you figure one is more apt to hold. Particularly also the MACD is heading lower here. RSI has been tapering off and heading lower as well. So lots of loss of upward momentum. So there's a good chance that any rallies that happen in the dollar will likely be capped by this region of these moving averages. And when I say that region, it can shoot up a little past it, much like it did here. Shoots up past it and then comes back down, kind of a thing. Now, again, the trend was still overall up here, so it comes back up and continues it. But if we are at the top of that C wave and the end of the fifth wave of the C wave, then this would be the top here. Again, history in hindsight will tell us for sure, but it's looking bearish for the dollar. And so if it's bearish for the dollar, then also want to talk about real quick, what is it good for? Well, the first thing it would be good for, the biggest, highest inverse correlation out there to the dollar, is gold. And so you notice as the dollar's been weakening over the last so many months, the gold has actually put in a higher low here than here. So it actually bottomed so far anyway towards the end of 2015. It had a massive ABC downtrend. So here's A, B, and elongated C, which is pretty typical. You draw a trend line across wave C, and it breaks here where it breaks above the 50-week moving average. And so that would make 2016 and 17 technically uptrending. It's just so early in the uptrending stage. Remember, there's 5 waves to an uptrend overall, and of course waves 2 and 4 are pullbacks. So we're so early in that phase. This would be wave 1. This would be a 3-wave pullback, wave 2, and we'd be just getting. We're in the early stages of wave 3, if I'm right. So if so, we've got 3, 4, 5, and this thing will really take off here shortly. And when I say shortly, that could be 60 or 90 days from now. That could be the next day or two or week or two. But you can't boil these things down to an exact time. And if somebody tells you they can, you need to turn and run, because they're either delusional themselves or they're not being totally honest with you. But you can kind of know the signs of the time, so to speak, of kind of basically where you are in something, and see this kind of bowl that's formed here, where the lows were getting lower, and then here's your first major low that's higher. And so once we push above this 1377 level here on gold and hold above it, more people will take note, and once it gets up, problem is that the media is probably going to really pile into covering gold when it's back up to like 16, 1700, 1800, etc. Probably nowhere near getting excited about gold in the 11, 1200s, even 1300s. So the problem with following the media is that you need to be in something before the media gets a hold of it. And if you're buying something when the media has gotten a hold of it, you probably bought it way too late in the trend. So notice the MACD is coming above the 0 line. Notice there was a golden cross here on gold with the 50-week coming above the 200-week moving average. Recent strength in the RSI as well. So gold can be a beneficiary. Silver doesn't have quite as high a correlation to gold. So gold usually benefits first, and silver is usually influenced quite a bit by the price of gold. So silver usually ends up tagging along. So a lot of times gold will respond first, and then silver have a delayed reaction and respond secondarily. Now, the benefit of silver is that in the end, so the benefit of gold is that it has the biggest direct, highest inverse correlation to the dollar of pretty much anything out there. The euro would be a close second. And silver, while not quite as high as a inverse correlation as gold, is highly influenced by gold, and so they tend to go up and down together overall. The benefit to silver is it tends to go up more percentage-wise than gold does, so that's the benefit there. So the MACD's been rising a bit here recently, could break above 0. RSI's been coming up. MACD looks like it's probably making a golden cross there on the weekly. and it's definitely had its ABC downtrend, which looks like it came to an end coming into 2016 as well. So gold and silver are definitely assets that can benefit from a falling dollar. The CRB index, which is the commodities in general, which is this is a basket of, I believe it's 19 commodities that are majorly used things that you have to have in life. Um, wheat and corn and soybeans and metals like gold and silver and energies like oil and natural gas, etc. The things that people use and have to have in day-to-day life, these are commodities. And as the dollar goes down, commodities tend to go up. And so you'll notice that so far the biggest bottom in commodities, the major A, B, C that unfolded over the last 8 or 9 years, likely ended right here coming into 2016. And so even though we've had a pullback here, this is likely a wave 2. So we're likely wave 1, 2, and 3, 4, 5. So we're likely going to see this come up quite a bit. It's too early to confirm that so far, but so far the 50-week moving average is trending higher. MACD's been trending higher overall. RSI been picking up steam as the dollar has been losing a lot of its steam. So gold, silver, commodities in general, which means commodity stocks in general, can rise and do well as gold does. As commodities and CRB index does better. The euro. So FXE is the euro. This one's had an ABC, kind of a sloppy, but ABC downtrend that likely completed coming into 2017, just before it. Again, it's too early to confirm it just yet, but more than likely that's taking place because the MACD is already moving higher. RSI is moving higher. The steepest part, the most recent part of the downtrend has been broken. And so there's a good chance that the euro benefits greatly from a falling dollar as well. And then there's, of course, the leverage version of it, ULE, which is moving also. So there's a number of different currencies that can have very inverse correlated effects to the fall of the dollar. So the fall of the dollar can stoke inflation. It can reduce one's consumer's purchasing power. But if those same consumers are investors and they invest in the right things, the things that go up with a devaluing dollar, then they can retain their own personal purchasing power, while many of the rest of the consumers in the country lose theirs. And again, it's not that you want anybody to lose their purchasing power, but we all know that every consumer is not going to become an investor, so that's just a reality. But so we can't affect what the Federal Reserve does. We don't have the power to do that. So if they want the dollar lower, or if government in general wants the dollar lower, you're not going to be able to stop that. However, what you can do is position your assets to where they benefit from the fall of the dollar. So there's always a play out there. So you don't have to like what's going on out there. You don't have to agree with what's going out there. But you can position your assets to benefit from it, even if you don't like it, even if you don't agree with it. So even if you say, hey, we should have a strong dollar, not a weak dollar, we should have increasing purchasing power, not watering down purchasing power, all those types of things, I would agree with you. But the fact remains is that the Fed's been doing this for a very long time. If you just look at the dollar over, say, something long like the past 30 years, they've been watering it down for a very long time. And you go back even further, and you see these long downtrends. So this is what I go to 45 years. The dollar had gotten in a bubble and reached its peak back in the 85, 86, or I think 85. And that was the ultimate peak of the dollar. And then it's been an overall downtrend ever since. It does have its rally up points within the overall larger downtrend, but people's purchasing power is being bled off over time, and that makes people poorer. Um, it makes the masses more easily controlled by people high up that are intentionally watering down their monetary clout. And so, to me, I'm not a conspiracy theorist, but I do believe if you're in power and in control, and you want to stay in power and control, it is easier to control an impoverished people, a poorer people, than it is a richer people. Richer people have choices; they have options. If you're rich and taxation gets too high, or there's laws enacted you don't like, or whatever, or there's things that are not beneficial to your business, you can move. If you're rich, you can move your assets, your money, your business. You can sell your stuff. You can relocate to other countries. You can do all kinds of stuff. You can buy second passports, all kinds of things. If you are enriched and have money, so the world's your oyster. You have choices. However, if you're impoverished and or you're being impoverished, meaning they're trying to take you from middle class to poor, you're stuck. You don't have the wherewithal, the ability, the means to be able to maneuver around like those who are better off can. So, therefore, that population is more easily controlled. So, I do believe there is that tactic out there. Whether you believe in that concept or not, it's undeniable, the trend of the dollar over the last several decades, and that's been lower. And so what we're likely about to go into is a period like this again and like this again after this bear market bounce up here. Here's your three waves up, A, B, C. So here's your three waves up here, A, B, C, and then you moved lower to a lower low than what we had here. So if this dollar index goes from 103, which is presently at 96s or so, goes from 103 at its peak down back to the 70s, that's going to be a massive move up for commodities, commodity stocks, gold, silver, uh, energy, like oil, et cetera. Even though oil doesn't have a super high inverse correlation to the dollar, and I haven't run its correlation. I just know from experience it's not near as high as like gold or the euro is as far as inverse correlation, but it has a massive effect on it. So while gold and the euro probably have like a 90-something% inverse correlation to the dollar, it's probably something more like 60 or 70-something% for oil. So it's still highly influenced by the move of the dollar. So as the dollar trends lower, which most of the masses are not expecting, because again, when this happened, they weren't expecting this to happen. When this happened, they weren't expecting this to happen. So as this has happened and unfolded, they're not expecting that to come to an end and for that to go lower. And all they've heard is inflation's lower and we've got deflation and blah, blah, blah. That's all they've heard for the last, that's all they've heard since this has happened. So since 08 on going, as the dollar has bounced back up, it's kept inflation lower and things of that sort. But as that comes to an end and you see that head lower, which again, with the MACD dipping lower, with the RSI dipping lower, with the ABC likely coming to an end, with the trend broken, etc. And if 91 gets broken, that would be lower than any of the recent supports in any of the recent years, and would be further confirmation because the floor would be broken here. You break below 91-ish. You break below this one little bitty spike, which most of the support was in the 93s and 94s. You also, once you get below the 91s, you break below the 200-week moving average, etc. And so it's really further proof that at that point, we're not there yet, but it will be at that point, that the uptrend is lower, and you'll see a lot more institutions shorting the dollar, if for no other reason by being long gold, silver, other commodities, commodity stocks, etc. And in sense, essentially short the dollar. And you'll see the dollar head down quite a bit lower, quite a bit quicker. So, and again, in the near term, I mean, there could be a bounce up, for a short period. There absolutely could, because when these things go down, they don't go straight down. They it down and then bounce back up and then down to a lower low here, and that was still just a pullback within the uptrend. When we're looking for not just a pullback, but a continuance of the long-term downtrend, it'll be much longer than that. But at some point, you pull back and you have a bounce up, and then the next, usually the C wave down is very, very long, C or 3, whichever one it ends up being. It tends to be very, very long and pronounced, and that's what hardly anybody is expecting, except for my informed subscribers and hearers, of course. And I'm sure I'm not the only one in the world seeing that or saying that. I'm not jaded, but it is rare. It is a rare number of voices out there that are sounding the alarms on these type of things. I will say that. Okay, so I just want to give you some thoughts on the dollar and dollar alternatives. And thank you so much for watching, and God bless. Bye-bye.